Hey everyone, welcome back to Corporate Decoder, where we unpack the secrets behind corporate jargon. And today, we're diving deep into Fission Incorporated's latest quarterly report. Get ready because this one's got more twists than a deep borehole. So, what is the big story here? Fission, a company aiming to build a nuclear reactor a mile underground, just dropped its Q3 report for 2025. And let me tell you, the numbers are interesting. If you want to get straight to the deep tech, join our Discord. Link is in the description. Scroll Fission Inc. Form 10. Scroll first off, legally, they are a smaller reporting company and an emerging growth company. That means they get some breathing room with reporting rules, which is common for newer companies. They've also confirmed they've filed all required reports and submitted their interactive data on time. As of mid-November 2025, they had over 50 million shares of common stock out there. That is a lot of pieces of the pie. Now, let's get to the heart of the matter, the financials. These are the numbers that tell us if this underground nuclear reactor dream is becoming a reality or just a very expensive experiment. Looking at their balance sheet for the 30th of September 2025 and comparing it to the end of 2024, there is a massive jump in assets. Cash and cash equivalents went from around $6.7 million to a whopping $30.2 million. That's a huge increase, suggesting they've been busy raising money. Their total assets grew from about $6.9 million at the end of 2024 to over $30.5 million by September 2025. Clearly, something big happened financially. On the flip side, current liabilities also increased from about $161,000 to $605,000. Not alarming yet, but keep an eye on that. This is where it gets complex. They had around $15.2 million in safe notes liabilities at the end of 2024. These are basically agreements for future equity, a way to raise money before a firm valuation. By September 2025, this liability is gone, showing they converted those agreements, likely into stock. This is the big shocker. At the end of 2024, they had a deficit in stockholders' equity of about $8.5 million. By September 2025, it's flipped dramatically to a positive $29.9 million. This huge swing is directly tied to the massive influx of cash from their private placement and the conversion of those safe notes. Now, let's look at how they made or lost money. For the 3 months ending the 30th of September 2025, their general and administrative expenses shot up to $6.7 million, a massive jump from just $486,000 in the same period last year. And R&D expenses also exploded from $219,000 to $2.1 million. This tells us they are spending heavily on building the company and developing their technology. This increased spending led to a staggering net loss of over $40 million for the quarter, compared to a loss of around $1.9 million in the same quarter of the previous year. That's an almost 2,000% increase in their net loss, which, while scary, is often typical for companies in a heavy development phase after a major funding round. Looking at the 9-month period, the story is similar. General and administrative expenses are $9.4 million, up from $1.2 million. R&D is at $2.8 million, up from $355,000. And the net loss for the first 9 months of 2025 is over $47 million, a huge leap from about $4 million in the same period last year. The big driver behind the volatile net loss for these periods is the change in fair value of safe notes. In the Q3 2025, this change was a negative $31.6 million, and for the 9 months, it was a negative $35.2 million. This reflects the accounting for those convertible notes. When they converted, the value changed significantly, impacting the P-FIDL. Even though it's a non-cash item, it's like paying off a loan with stock, and the accounting for that conversion can create big swings in reported profit or loss. They are also burning cash on stock-based compensation. For the 9 months ending September 2025, it was over $5.5 million, a huge jump from just about $140,000 in 2024. This is them giving out stock and options to employees, which is standard but expensive. And then there is the elephant in the room from the financial tables, the merger and private placement. This company underwent a significant reverse recapitalization with a merger, basically Fission Inc. The one we're looking at acquired legacy Fission. Legacy Fission is now essentially the surviving entity. The private placement simultaneously sold 10 million shares at $3 per share, raising $30 million. This is why their cash position surged, and the total shares outstanding jumped from about 16.3 million at the end of 2024 to over 50.8 million by September 25. That's a massive dilution. The safe notes, as mentioned, were converted. This was a major event, as seen in the statement of cash flows. The conversion of safe notes into common stock brought in over $53 million, essentially turning debt like instruments into equity. We see this influx of cash in the cash flow statement. For the 9 months ending the 30th of September 2025, cash from financing activities was over $30 million, mostly from that private placement. Cash from operations was a negative $6.5 million, meaning they are bleeding cash to run the business. Now, the crucial part, their liquidity and going concern. They ended September 2025 with over $30 million in cash. That sounds great, right? But they are burning through cash like crazy. For the 9 months of 2025, they used $6.5 million in operations and had a net loss of over $47 million. They explicitly state there is substantial doubt about the company's ability to continue as a going concern within 1 year. This means without more funding, they might not make it. They plan to get more capital through public or private offerings, but Therese, no guarantee. The amount of stock-based compensation, especially through their 2025 equity incentive plan, is significant. They granted options for over 1.4 million shares in late August 2025, and these are being expensed over time. This is a common way for startups to attract talent, but it dilutes existing shareholders and is a major expense. They even granted restricted stock units to new directors in November 2025. There are also related party transactions. A consulting agreement with Deep Isolation, Inc., a company co-founded by their own CEO, for technical and regulatory guidance. They paid $12,500 for this. In the past, they also had a loan from a related party that has since been repaid. In November 2025, there were some leadership changes. Richard A. Muller resigned from the board but remains CTO. Michael Brazel was appointed Khufu and John Gordon General Counsel and Secretary. The board also added 2 new directors, Leslie Goldman Tepper and Jonathan Angel, and reconstituted committees. This is typical for a company maturing and going through a merger. Diving into the management's discussion, they clearly state their business is developing a deep borehole pressurized water reactor aimed at providing clean, secure, and low-cost electricity. They were selected by the US Department of Energy for a pilot program with the first test reactor anticipated by July 2026. That is definitely the exciting, high-risk, high-reward part of their story. Their strategy is to be a technology provider and partner, letting others handle the heavy lifting of project financing and construction. This allows them to scale faster without tying up too much of their own capital. They plan to make money from reactor delivery, integration, and IP licensing. Looking at the big picture from management's perspective, the increase in expenses is clearly attributed to growth, hiring more people, and developing their technology. The big jump in non-operating expenses is primarily the change in fair value of those safe notes. They acknowledge their heavy reliance on external financing. While they have over $30 million in cash now, a significant portion came from the private placement. They're burning through cash and need more, which is their biggest challenge. They've got a cool idea, but execution and funding are the make or break factors. It is worth noting their disclosure controls and procedures were not effective as of the 30th of September 2025 due to identified material weaknesses in internal financial controls. This is a red flag, and something investors should definitely be aware of. It means they need to strengthen their internal financial reporting processes. The risk section, whether in the annual report or implied here, would undoubtedly talk about regulatory hurdles, safety concerns inherent in nuclear power, financing challenges, and competition. Building advanced nuclear reactors is not for the faint of heart, and the regulatory pathway alone is incredibly complex. Finally, the certifications from the CEO and CFO are standard. However, the previously mentioned weak internal controls cast a shadow. So, what is my take on Deep Fission's situation? They are playing in a high-stakes, high-reward industry. The underground nuclear reactor concept is innovative and addresses some key energy challenges, especially with the demand from AI and data centers. They've successfully raised significant capital, which is a testament to investor belief in their vision, and the merger and safe note conversion are major financial milestones. However, the massive increase in operating expenses and the resulting huge net loss are significant. The going concern warning is the most serious red flag here. It means this is a highly speculative investment, and they will likely need to raise more money soon. The material weaknesses in internal controls also point to operational challenges that need immediate attention to build investor confidence. The company is in the very early stages of development. With a test reactor planned for July 2026, that's still a ways off, and the road from a test reactor to commercial viability is long and fraught with technical, regulatory, and financial hurdles. The company's strategy to partner on financing and construction is smart for scaling, but it also means they are heavily reliant on third parties. In conclusion, Deep Fission has a potentially groundbreaking technology in a critical sector. They've demonstrated an ability to attract capital and execute major financial transactions like the merger and private placement. But they are burning cash at an alarming rate, face significant operational and regulatory risks, and their financial stability hinges on their ability to secure continuous funding. This is not an investment for the risk. Averse, it is a bet on a future energy solution with a very uncertain path to profitability. Alright, that is our breakdown of Deep Fission's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think underground nuclear power is the next big thing or just a pipe dream? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description below for more discussions and to connect with fellow corporate explorers. Thanks for watching and see you next time on Corporate Decoder.